As we delve into 2024, embedded finance continues to reshape the financial industry. Today, we bring together a few experts to shed light on the different aspects of this subject.
Embedded finance, first of all, I think it's important to define what is embedded finance. And embedded finance is really the opportunity to deliver a financial product or service through any platform and any technology as part of any customer experience without necessarily having the infrastructure of the payment or financial license.
I think embedded finance is really interesting. What people want is, well, in reality, they don't want finance. They don't want a loan. They want, the jeans. They don't want a BNPL, they want a TV. They don't want a mortgage, they want a house. So that's the beauty of embedded finance. It sits behind the product that consumers actually want and need.
What we see in embedded finance is the usage of a lot of wallet technology, wallet solutions, where customers get a wallet account. It creates a closed loop ecosystem. They can pay with that wallet on a marketplace. These types of solutions are very popular. We're also seeing a movement away from payment providers that try to take the customer experience and onboard those customers for themselves and create a multi-platform payment experience. Actually, retailers want the customers to be their customers. They want to own the customer journey. They want to own the customer experience. They don't want other brands polluting that environment. They want end-to-end control over that.
The most obvious success has to be BNPL, where people view buy now, pay later as just a fantastic value add to them. It allows them to get their product now and to pay for it later, and they don't view it as banking relationships.
Well, I think the main difference between European and US BaaS models lies in regulation. So in Europe, obviously we have open banking such as PSD2, which mandated the sharing of data between institutions and obviously fintech providers. And what that has done is allowed more of a collaborative framework, a collaborative nature, which has also meant more innovation. In the US, it's a bit less regulated and more fragmented. So different states have different regulations, and that's led to more competition. So I think the main difference lies in the regulations.
Banks and other financial service providers, fintechs, do have a responsibility towards their end customers. Yes, it's about making a sustainable profit and helping society help themselves. But of course, embedded finance can also bring some risk here, and the industry needs to work together to actually continue pushing this forward. One big risk, especially in the United States, is always how do you deal with fraud and how do you deal with financial crimes here. The country is still suffering in many forms from somewhat higher fraud rates, particularly in payments. And we're seeing some advantages, be it EMV, we're seeing new forms of fraud protection coming in, but they need to be consistently applied and pushed through.
The reason why embedded finance is growing in popularity today is because we now have the perfect environment and combination of both regulatory environment and technological developments to offer that infrastructure to all digital businesses in order to be able to integrate financial services seamlessly in their existing user journeys and platform and technologies.